Imagine this. A simple line on a chart rises slowly, then suddenly collapses, erasing trillions of dollars in days. We see this line all the time, on the news, on trading apps, on social media. But behind this innocent curve lies a cycle that has quietly repeated for more than a century. The Great Depression of 1929, the stagflation crash of the 1970s, the dot-com bubble in 2000, the housing crisis in 2008, the pandemic crash in 2020. Different decades, different technologies, different investors, but the same underlying pattern. A rise that feels safe, a peak that feels euphoric, a decline everyone dismisses, and a collapse no one sees coming. Today, we're going to break that pattern open, calmly, simply, and visually, to reveal why stock markets crash every decade and why the answer has less to do with numbers and more to do with human behavior. Stock market crashes feel unpredictable, like lightning strikes or earthquakes. But when you zoom out far enough, the randomness disappears. Economists have spent decades trying to forecast the exact moment a crash will happen. Some use equations, some use AI, some use complex models. None of them can predict the exact day or the exact hour. But what is predictable is the cycle. Because the stock market is not just a financial machine, it is a mirror of human psychology, fear, greed, optimism, denial, panic. These emotions don't change. Not in 1929, not in 2008, not today. And because human behavior moves in cycles, financial markets do too. In this video, we'll explore that cycle step by step, how it begins, how it grows, how it breaks, and why it repeats every decade, almost like nature resetting itself. The goal is simple, to understand why crashes happen, not to fear them. Because when you understand the rhythm, the market becomes less of a mystery and more of a map. Every major crash begins during a period of calm. When the economy is stable, interest rates are low, and credit is cheap, investors become comfortable. When they become comfortable, they take more risks, and when risks increase, asset prices rise. This phase is called exuberance, slow, steady optimism. In the 1920s, people bought stocks using borrowed money. In the 2000s, people bought houses with loans they couldn't afford. In the 2010s, people rushed into tech stocks and crypto. Different assets, same psychology. A simple rule of markets. Stability breeds risk, and risk breeds instability. The safer things feel, the more dangerous they quietly become. Eventually, the optimism becomes something else. Euphoria. This is when people stop asking questions. The dot-com bubble is the best example. Companies with no profits, no revenue, no real product were worth billions overnight. Investors weren't buying businesses. They were buying dreams. In euphoria, three things happen. Prices rise faster than reality. People believe this time is different. New investors flood in, chasing easy wins. Euphoria is the peak of the cycle, but it never feels like the peak. It feels like the beginning of a new era, and that illusion is exactly what sets the crash in motion. Crashes don't start with panic. They start with small cracks. A company misses earnings. A bank reports higher default rates. Interest rates rise slightly. A new regulation spooks investors. At first, people ignore it. Analysts say, it's temporary. It's healthy. Just a correction. This phase is called denial, and it's dangerous because it delays the inevitable. In 2007, banks began showing signs of weakness. Experts dismissed it. They said, the housing market is strong. Within a year, the entire global financial system collapsed. The cracks are always visible. People just choose not to look. Then comes the moment when confidence snaps. Buyers disappear. Sellers rush in. Prices fall in minutes. This is panic, the shortest phase of the cycle, but the most dramatic. In 1929, the market lost 30% in 2 weeks. In 2008, Banks failed within days. In 2020, global markets fell faster than any time in history. But here's the deeper truth. The numbers didn't cause the panic. The psychology did. When investors lose trust, they don't sell because price is falling. They sell because they fear it will keep falling. Fear becomes contagious. It spreads faster than logic. And suddenly, everyone is running for the exit at the same time. After the collapse comes silence. This phase is called despair. It feels dark, slow, hopeless. But historically, this is where the greatest opportunities exist. In 1932, after the Great Depression, stocks were down nearly 90%, but the next decade produced massive gains. In 2009, after the housing crash, the S&P 500 began a 10-year bull run. In 2020, after the pandemic crash, markets rebounded within months. Fear creates low prices. Low prices create future returns. And slowly, the cycle begins again. Here is the truth nobody tells you. Stock markets don't crash because of economics. They crash because of human nature. Every decade, a new generation enters the market. They believe they're smarter than the last. They believe technology has changed everything. They believe they've found a way to escape the cycle, but human psychology hasn't changed in thousands of years. And because humans are predictable, markets are predictable too. The real pattern isn't financial, it's emotional. The market rises when people feel safe. It peaks when people feel invincible. It cracks when people feel uncertain. It collapses when people feel afraid, and it recovers when people feel hope again. There is no single cause, no single event, no single villain. It's us. Our optimism, our denial, our fear, our hope. The market is not a machine. It's a story we tell ourselves. And every decade, we rewrite the same story. If you take one lesson from this video, let it be this. Crashes are not the end of the market. They are part of its rhythm. Every rise carries a warning. Every fall carries an opportunity. And every generation repeats the same cycle until they finally learn to see it. You don't need to predict the next crash. You only need to understand the pattern. I'm the Lazy Economist, explaining the psychology behind money in calm, simple ways. If this helped you see the market differently, subscribe and share this video with someone who needs clarity, not panic. Because the more you understand the cycle, the less the cycle controls you.